The $7 trillion gold and silver wipeout, the painful lesson. No one wants to talk about something just happened in the global financial system, and almost nobody truly understands what it means. A $7 trillion wipeout, not in crypto, not in meme stocks, but in gold and silver, assets people were told would always protect them. This wasn't a glitch, it wasn't a temporary dip, and it definitely wasn't random. Because when safe havens start bleeding, it's not a market correction, it's a warning. Today, we're going to break down what this $7 trillion wipeout really means, why gold and silver didn't behave the way people expected, who actually lost money, and who quietly won, and the painful lesson this moment is teaching every investor on Earth. Stay with me until the end. Because what this reveals about risk, trust, and control might completely change how you look at money. The myth of safe assets. For decades, we've been told the same story. When markets crash, when currencies weaken, when governments overspend, buy gold, buy silver hide in hard assets. Gold was supposed to be the ultimate insurance policy, silver the affordable alternative. And to be fair, historically, that story made sense. Gold survived empires. Silver powered trade for thousands of years. They don't default. They don't go bankrupt. They can't be printed. But here's the uncomfortable truth. Gold and silver are not immune to modern financial systems. They may be ancient assets, but they are now traded in highly engineered, leveraged, paper-based markets. And that's where the illusion begins to crack. What does a $7 trillion wipeout actually mean? Let's slow this down, because this number matters. $7 trillion didn't disappear overnight like a crypto rug pull. This wipeout represents lost market value over time, missed expectations, investors who bought at peaks and held through declines, capital that thought it was protected, but wasn't. This includes gold ETFs, silver futures, mining stocks, derivatives, and leveraged exposure. Not people holding a single coin under their mattress, but institutions, funds, pensions, and long-term savers who trusted the financialized version of precious metals. And that distinction is critical, because paper gold is not physical gold, and price exposure is not ownership. Why gold and silver failed to protect investors? This is where things get uncomfortable. Gold didn't collapse because it lost value. It struggled because the rules of the game have changed. Here are the real reasons behind the wipeout. 1. Rising interest rates. When interest rates rise, gold suffers. Why? Because gold yields nothing. Suddenly, bonds pay interest, cash pays interest. Even short-term instruments become attractive. Gold becomes a cost to hold, not a refuge. 2. A strong dollar. For now. Despite massive debt, the US dollar remains dominant. Global trade, oil, debt markets, still dollar-based. So when fear hits, investors don't run to gold first. They run to liquidity, and liquidity means dollars. 3. Forced selling. This is the part nobody likes to talk about. When markets fall elsewhere, stocks, real estate, crypto, investors sell whatever they can, not whatever they want. Gold becomes collateral. Gold becomes liquidity. Gold becomes something to dump, not because it failed, but because it was easy to sell. Paper gold versus real metal. This wipeout exposed a dangerous misunderstanding. Most investors don't own gold. They own promises, contracts, shares, IOUs. If everyone demanded physical delivery at once, there wouldn't be enough metal. That's not conspiracy, that's math. And when price is determined by paper volume, not physical scarcity, gold stops behaving like money and starts behaving like a derivative. This is why prices can be smashed, volatility spikes unexpectedly, long-term holders feel betrayed. Who actually lost money? Let's be precise. The biggest losers were late-cycle buyers, ETF holders who bought during fear peaks, pension funds seeking safe diversification. Retail investors who thought gold was a guaranteed hedge. Many of them were told, just hold it long enough. But time doesn't protect you if you buy at the wrong moment. And here's the cruel irony. Those who needed safety the most often bought it at the highest price. Who won quietly? Now here's the part the headlines won't tell you. Some players benefited massively. Traders who shorted paper gold. Institutions that arbitraged futures versus physical, central banks buying quietly during weakness, large holders accumulating at discounted prices. Yes, central banks are still buying gold, just not from you and not at your price. This is how wealth moves, from emotional hands to patient ones. The painful lesson. So, what is the real lesson of this $7 trillion wipeout? It's not gold is useless, and it's not silver is dead. The lesson is far more uncomfortable. There is no such thing as a risk-free asset. There is no automatic protection. Context matters more than narratives. Gold is not a magic shield. Silver is not a guaranteed hedge. And safe haven is not a permanent label. Everything carries risk, especially when everyone believes something is safe. What this signals about the system. When even traditional hedges fail to perform as expected, it tells us something deeper is happening. The system is under stress, liquidity is king, and trust is thinning. This is not the end of gold, but it may be the end of blind faith in it. And that should make everyone pause, because when faith disappears, volatility replaces it. The bigger question. So here's the real question you should be asking. If gold and silver can be distorted, if bonds are unstable, if currencies are being diluted, where does safety actually exist? And the answer might be unsettling. Safety today is not an asset, it's a strategy. Diversification, timing, liquidity awareness, understanding cycles, knowing when not to follow the crowd. Final warning. The $7 trillion gold and silver wipeout is not a failure of metal. It's a failure of expectations. A reminder that markets don't care about tradition, narratives change, and protection is never guaranteed. If this shook your confidence, good, because complacency is far more dangerous than fear. If this video made you think or uncomfortable, that's the point. If you found value here, hit like. Subscribe if you want deeper, calmer breakdowns of financial reality. And comment below, do you still trust gold and silver as safe havens, or has this changed your view? Until next time, stay alert, stay curious, and protect yourself, not the narrative. This is Felix. See you next time.